Or you may be scrolling through your feed right now, Instagram or Facebook perhaps, and wondering about the huge company behind it all. That's Meta Platforms, of course. And today, we're really diving deep into, well, the big question. Is this tech giant actually a smart investment for you at this moment? Welcome to De-Risk, a podcast where we provide a no-nonsense analysis of stocks. So, our mission today is to properly unpack the investment profile of Meta Platforms, Inc. You probably remember them as Facebook, Inc. We've just been digging through a whole load of our latest research on Meta, and honestly, what we found were some really fascinating signals and frankly, some conflicting ones too about where it stands. It's quite a puzzle. So we're here to try and help you make some sense of it all. Okay, so to start us off, let's just lay the groundwork. What exactly is Meta Platforms today? How does the business actually work?
Right. Well, at its core, Meta operates through two pretty different main segments. First up, you've got the family of apps, or FOA, as they call it. Now, this is the powerhouse everyone knows, right? Facebook, Instagram, Messenger, the new Threads app, and WhatsApp. These are all about connecting people, connecting businesses across the globe. And, well, let's be clear, this is Meta's cash cow. It's their advertising engine, brings in almost all the money.
Main engine, got it.
Exactly. Then you have the other part, the more forward-looking Reality Labs segment. This is really Meta's big bet on what's next. It's where they're pouring significant investment into developing virtual reality, augmented reality, mixed reality.
The metaverse stuff.
Precisely. Think of VR headsets like the Quest, smart glasses.
Right.
It's their long-term vision, for whatever comes after the smartphone era.
Okay. And speaking of that cash cow, the family of apps, let's talk financials. There was that noticeable dip back in 2022, felt like a real wobble. But since then, Meta seems to have really staged an impressive comeback. What do the numbers in our research actually tell us about this recovery?
Oh, the recovery has been nothing short of robust, really. Our research shows Meta's annual revenue growth properly reaccelerated, hit almost 22% in 2024.
22%, that's huge.
It is, reaching a massive $164.5 billion. And this isn't just like a simple rebound. Meta's core ad engine is roaring back. It shows surprising resilience, maybe hints that their ad tech is, more effective now than ever. Perhaps the market wrote them off a bit too soon on that front.
Interesting. And what about profitability? Did that recover too?
Yes, and that's equally impressive. Their profitability margins, things like EBITDA, operating margins, they've significantly expanded. They're actually surpassing 2021 levels now.
Oh.
And critically, net income and earnings per share, they recovered sharply too. If you look at the recent quarterly data, we see continued revenue growth. There was a brief dip Q1 2025, but it bounced back really fast in Q2. Shows they can recover quickly.
So resilience there too.
Definitely. And they've also optimized their R&D spending, as a percentage of revenue. And their tax rates, while they fluctuate a bit, seem pretty reasonable overall. So yeah, despite those past hiccups, the overall financial picture now is one of, strong recovery and pretty impressive expansion.
Okay, so Meta's cash cow is clearly back, generating strong numbers. But the million-dollar question for any investor is the market actually appreciating this turnaround? Is there still value, or is it all priced in? Our research suggests it's, a bit of a puzzle when you stack them up against their tech peers.
It absolutely is. When we compare Meta using those standard valuation metrics, price to earnings ratio, or EBITDA, which is enterprise value to earnings, our research consistently shows Meta often trades at a more conservative valuation, sometimes even looks discounted compared to the average of its peers.
So what does that actually mean? Is it undervalued, or is something else going on?
Well, that's the implication, right? It could suggest potential undervaluation, or perhaps it reflects some lingering market skepticism about its big strategic bets, particularly that heavy investment in Reality Labs. It's almost like the market is saying, okay, great ad business comeback, but show me the money on the metaverse stuff first.
Right, the prove-it mentality.
Yeah.
And when our research tried to calculate a specific fair value for the stock, it didn't exactly make things clear, did it? Found quite a big discrepancy.
Yeah, that's where the puzzle really gets deep. Our free cash flow-based analysis, looking at the actual cash the company generates, suggested a fair value of around $628.
Okay.
Now, compared to its current market price, which is up around $776, that would actually imply it's overvalued.
Overvalued, okay.
But then, hang on. When we looked at it based on earnings per share profitability, the picture just completely flipped. That model gave us a fair value way up at $1,323, which would suggest it's significantly undervalued.
Oh, that's a huge range. $628 versus over $1,300.
Exactly. So given this incredibly wide range and these conflicting signals from different perfectly valid valuation models, our research basically concludes that the stock is probably fairly valued right around its current price. It's definitely not a clear-cut bargain, nor is it obviously way too expensive. It's complex.
Right, a complex picture indeed. It's a fascinating split. Okay, let's talk about what is clearly captivating the market right now, driving the whole narrative for Meta. That's their huge push into AI, artificial intelligence. It's obviously a massive investment, but has it actually translated into tangible results, stuff we can see on the bottom line now? Or is it still mostly promise? What's our research say about the impact on ad revenue specifically?
Oh, AI is definitely driving real results already, not just future hype. Our research shows that over just the last 3 months, Meta's launched a whole barrage of new products, strategic shifts, all centered on AI. They're even talking about shifting towards personal superintelligence. And they've poured huge investments into AI labs, into talent. On the product side, they've rolled out enhanced AI features across, well, pretty much all their apps. We're talking generative AI for video editing, much better content recommendations to, keep you scrolling.
Keep us hooked, yeah.
Exactly. And crucially, AI-powered advertising models. These are designed to be way more effective for businesses placing ads. They've also introduced new AI models, things like VWAP, launched actual AI devices like those Oakley Meta smart glasses, and a MetaQuest gaming edition. Even WhatsApp is getting new features, seeing big growth in business messaging, all of it boosted by AI integration.
Okay, so the AI push is real and broad. How has that actually shown up in recent company performance, and what's the wider sector news telling us?
It's translated very well, and pretty quickly, too. Our research shows Meta reported a really strong Q2 2025. Beat expectations pretty much across the board.
Good news for them.
Absolutely. And this was largely driven by those AI advancements directly boosting the ad business. They saw more ad impressions, just more ads being shown, and a higher average price per ad, because those AI models are driving better conversions for advertisers. So essentially, AI is making their ad platforms smarter, more efficient, and more valuable.
Makes sense. Better results for advertisers means they'll pay more.
Precisely. The company also gave an optimistic outlook for Q3, and they're seeing really significant growth outside North America too. Plus, their operating margins have improved, partly because they're using AI automation internally, making the company leaner.
Yep.
And it's not just Meta seeing this. Analysts have mostly raised their price targets, citing this AI-driven growth. The whole tech sector is kind of rallying on AI adoption right now. So it's a really powerful tailwind for Meta.
All right. Now, for those of you listening who like to look at the stock charts, the technical picture.
Yeah.
Well, this is where things get really interesting. Our research reveals a picture that's almost bipolar. You've got some signals practically screaming buy, while others are flashing caution signs. It's like the market itself can't quite make up its mind.
It really is a fascinating snapshot of current investor sentiment. Let's break it down. On the bullish side, the buy signals, we're seeing several strong indicators pointing towards continued upward momentum.
Okay, what are those?
Well, first, just looking at the basic price action, there's been a significant upward move, a really sharp spike recently, breaking clearly above previous trading ranges. That indicates strong buying interest, suggests the bullish trend might even be accelerating. Short to medium term, that looks bullish. Momentum seems to be with the buyers.
Right, clear upward move.
Second, key momentum indicators like the MACD. They're flashing pretty strong buy signals. The main MACD line crossed above its signal line. The histogram's positive. It confirms buying pressures picking up. The stock has wind in its sails. Third, if you look at moving averages, both short-term and long-term, the price is way above them. And the shorter-term average recently crossed above the longer-term one. That's a classic golden cross type signal. Very clear indicator of a confirmed bullish trend. A definite buy signal there.
Got it. Price, momentum, averages, all looking positive.
And finally, the Ichimoku cloud. It gives a really comprehensive view of the trend and potential support levels. The price is well above the cloud. The cloud itself is bullish and rising. All the Ichimoku components point to a strong bullish trend. So yeah, lots of powerful signs for the bulls here.
Okay, so the longer term charts, the momentum, definitely screaming buy. Seems like Meta still has a lot of runway based on that. But you mentioned a bipolar picture. So what about the other side? The bearish signals, the cautionary flags. Where's the market hinting at potential trouble ahead?
Yeah, and that's where the real tension comes in, because while that overall trend is clearly up, the very recent price action, it shows some classic signs of a stock that's maybe run up too hot, too fast, hinting at a potential pause or even a pullback.
Ah, okay. Like what specifically?
Well, for instance, look closely at the candlestick chart. After that big jump up, that upward gap, we saw two pretty large consecutive red candlesticks. The last one closed significantly lower. That indicates strong selling pressure, maybe people taking profits after the run-up. It points to short-term bearish momentum, a potential pullback.
Red candles after a big jump. Got it.
Then there's on-balance volume, OBV. It basically tracks money flow based on volume. We've seen a sharp decline in OBV recently. It's moved significantly below its moving average. That indicates increasing selling pressure, suggests money might actually be flowing out of the stock in this very recent period.
Money flowing out despite the price rise.
In the very short term, yes. And the Chaikin Money Flow Indicator, CMF, confirms this. Its values have been consistently negative recently, confirms net money outflow, points towards a bearish trend and maybe even a sell signal in the short term.
Okay, so volume indicators are looking negative. What else?
Another key warning sign comes from Bollinger Bands. The price surged up so dramatically that it stayed above the upper Bollinger Band for several days, several candles.
Right, pushed outside the band.
Exactly. That's a classic indicator of an overbought condition. It suggests the price moved too far, too fast. Like a rubber band stretched too tight, it might be due to snapback, meaning a pullback or correction could be imminent. Supports a sell signal, or at least caution.
Overbought, okay.
And finally, the average true range, or ATR, that measures volatility. It's seen a sharp increase in just the last few days. Now, given those recent red candlesticks we mentioned, this suggests significant and potentially negative short-term price swings are more likely. So the immediate signals are really saying, hang on, wait for confirmation before jumping in.
Wow, okay, so it really is a tale of two charts. Strong underlying trend, but flashing warning signs in the immediate term. So, after navigating all that, the strong comeback, the AI excitement, those quirky valuation metrics, and now these really contradictory chart patterns. How do we pull all this together? How do we translate this into a clear recommendation for you, the listener? What's the bottom line from our research?
Yeah, it's a lot to weigh. Based on this whole comprehensive analysis, looking at everything, our research leads us to a pretty clear recommendation for meta platforms right now.
Hold. Oh, okay, why hold specifically? Not buy, not sell.
Well, there are really three main reasons driving that hold recommendation. First, as we just spent time detailing those conflicting technical signals, it's a major factor. You've got numerous indicators pointing to strong bullish trends, continued buying interest, but then you have several others, especially the very recent price action, volume overbought indicators suggesting bearish momentum and potential pullback. It just creates a really mixed, uncertain technical picture right now. Makes a strong conviction buy or sell feel pretty risky. It's like standing at a crossroads with signs pointing both ways.
Right, too much uncertainty on the charts themselves.
Yeah.
What's the second reason?
Second is that whole fair valuation and comparative discount puzzle we talked about earlier. Remember the fair value analysis? Huge discrepancy between models. Leads us to conclude it's probably fairly valued right now where it sits. And while it does often trade at a discount to peers, which could be an opportunity, it also likely reflects those market concerns we mentioned, maybe higher perceived risks around reality lab spending, for example. So it's not screaming cheap, nor is it screaming expensive. It's in the middle. Fairly valued.
Okay, valuation isn't a strong push either way.
Yeah.
And the third reason for hold?
Third, it's really about balancing the strong fundamentals and that exciting AI story against the short-term volatility we're seeing. Look, Meta's financial recovery is strong. Revenue growth is back. Margins are expanding. Their investments in AI are clearly paying off and are a huge long-term positive driver. That's the foundation you probably want to be invested in.
Right, the long-term picture looks good.
Exactly. But that recent rapid price run-up, combined with those short-term bearish technical flags, suggests we could easily see some volatility, some profit-taking, maybe a dip in the near term. So holding allows you, the investor, to stay positioned to benefit from those strong fundamentals and the AI growth story without necessarily jumping in right at a moment of potential short-term uncertainty or pullback.
Makes sense. Ride out the potential short-term storm while keeping exposure to the long-term positives. Now, of course, no investment is risk-free. What are some of the potential roadblocks or counter-arguments our research highlighted? Things investors should definitely keep in mind with Meta.
Absolutely, there are always risks. One key counterargument is that those huge capital expenditures for Reality Labs, well, they might not generate substantial returns anytime soon, certainly not in the short to medium term. That's a lot of cash going out the door without immediate profit coming back in. That could be a drag on overall profitability for a while.
The metaverse costs.
Okay, right. Second, you always have ongoing regulatory pressures. Governments around the world are constantly looking at Meta, at social media, and the competition is still incredibly intense. Those are constant risks to the core ad business.
True. Never goes away.
And finally, that little dip in revenue back in Q1 2025 we mentioned, combined with these recent short-term bearish technical signals, well, it could signal a more significant pullback is possible if things don't continue to execute perfectly. It's a risk to watch.
Okay, important risks to track. So for our listener, wrapping this all up, what are the practical, actionable next steps based on this deep dive into Meta?
Yeah, the most concrete steps really involve careful monitoring from here. First, investors should definitely monitor Meta's upcoming Q3 2025 earnings report. Look for confirmation of continued revenue growth and stable or improving margins.
Keep an eye on the numbers.
Exactly. Second, pay very close attention to the performance of those AI initiatives. Are they continuing to boost the ad business as effectively? Watch the updates there. And also, keep an eye on the Reality Lab segment, any signs of progress towards profitability or maybe significant user adoption.
Track the AI and the metaverse progress.
Got
it.
And third, probably most importantly in the near term, observe the stock's price action very carefully. You need to see a clear resolution of these conflicting technical signals we discuss. Look for either a confirmed bounce off a support level showing the pullback is over, or maybe a sustained break above the recent highs confirming the bulls are back in full control. Only then might you consider new long positions. Patience is really key right now.
Patience and watching for confirmation. Seems like sound advice, given the mixed signals. It really is fascinating how a company like Meta, with such a clear, long-term vision, the AI wins recently, how it can still present such a volatile, uncertain, short-term technical picture. It really makes you think about the different lenses we use to look at investments, doesn't it? That tension between the long-game potential and all the immediate market noise. Something to mull over. That's all for this episode. Remember, this podcast is for informational purposes only and isn't financial advice. Always do your own research or consult with a qualified financial advisor before making any investment decisions. Thanks for tuning in, and we'll catch you on the next episode of D-Risk.